When developing a financial plan, people have a tendency to focus on the exciting stuff. How much they're going to invest, what they're going to invest in, and how that's going to compound over time to create financial independence. But what about when things go wrong? A good financial plan should include risk mitigation strategies built in for when things don't go to plan. One element of risk mitigation is income protection. While you're on the journey to achieve financial independence, your ability to earn an income is your greatest asset. It is a tool which gives you the capacity to save, invest, and cover living expenses. Despite this, it's amazing how many people insure their homes, cars, pets, and even phones, but aren't willing to insure their biggest asset, which pays for all of these things, their income. Today, we're going to bring more awareness to income protection so you can better understand what it is and how it works. Income protection, sometimes also called salary continuance, is an insurance policy that provides a monthly benefit if you're unable to work due to accident, illness, or injury. You might be thinking, isn't that what workers' compensation is for? No, there's a difference. Workers' compensation is a policy taken out by your employer, which covers you, as the employee, if you're injured at work or become sick due to your work. If you have an accident, illness, or injury that's unrelated to your work, workers' compensation won't pay out in that event, but income protection would. The primary components of an income protection policy are the monthly benefit, waiting period, and benefit period. Let's discuss each of these components in more detail. The monthly benefit is your sum insured. It is the amount of money that you will receive in the event of a claim. The maximum monthly benefit you can apply for is 70% of your gross annual income. For example, if you earn $100,000 a year, your maximum monthly benefit is $5,833. You don't have to apply for the maximum amount. You can reduce it to only what you need. For instance, if your maximum monthly sum insured is $5,833, but you only need $4,000 per month to cover basic living costs, you might choose to reduce your sum insured to $4,700 per month. The reason we didn't suggest a $4,000 per month benefit, which would be in line with your expenses, is because the monthly benefit is taxable. You need to factor in tax payable on the benefit and consider how much you would be left with after tax. The waiting period is how long you need to be off work before you can make a claim on the policy. You can generally get a waiting period of between 14 days and 2 years in set increments. The shorter your waiting period, the more expensive your cover will be. Given this, you need to make consideration as to what length waiting period is appropriate for your situation. For example, if you have an emergency fund in place that will cover living expenses for up to 3 months, you may want to opt for a 90-day waiting period. You may also want to factor in accrued annual leave and sick leave, which will be paid out in the event you're unable to work. Just as a word of caution, be careful when you're applying for an extended waiting period due to accrued annual leave and sick leave. If you leave your employer and lose your entitlements, you can't reduce your waiting period without going through medical underwriting. We'll discuss medical underwriting in more detail later. Also, the monthly benefit is paid in arrears. That's at the end of the month. This means that if you have a 30-day wait, your first payment would be made 60 days after you ceased work. The benefit period is how long your policy will continue paying for if you're unable to work. This can range anywhere from 2 years up to age 70 in set increments. Most insurers cap the maximum benefit period at age 65. The longer your benefit period, the more expensive your cover will be. Given this, you need to make consideration as to what length benefit period is appropriate for your situation. If you have an income protection policy with a 30-day waiting period and a benefit payable to age 65, this means you would need to be off work for 30 days before you can make a claim on the policy, and it'll continue paying a monthly benefit up until age 65 if you're unable to return to work, subject to ongoing requirements being met. There are some instances where you might want to reduce your benefit period in order to reduce your premium. For example, if you are 35 and on track to achieve financial independence by age 40, you may want to opt for a 5-year benefit if your income isn't needed beyond that point. You have the option to structure your income protection inside super or outside of super. If you choose to structure your income protection inside super, the premium will come out of your superannuation fund. Conversely, if you choose to structure your income protection outside of super, the premium will be payable by you personally. Cash flow permitting, we often suggest income protection policies are structured outside of superannuation as it is a tax-deductible expense. For example, if you're on the top marginal tax bracket of 47% when Medicare levy is included and your income protection premium is $2,000 per year, the net cost of your cover after factoring in the tax benefit is only $1,060 per annum. On the other hand, if you fund that same premium via super, your super fund claims a tax deduction at the super rate of 15%, giving you a higher net cost of $1,700 per annum. If your cash flow is tight, it is better to structure income protection inside super rather than not have cover. But remember, if you can't afford income protection, then you also can't afford not to have it. The cost of your income protection is going to vary dependent on a number of factors, including your age, gender, occupation, smoking status, and policy benefits. With regards to occupation, if you have a sedentary occupation, you can expect to pay less than someone with a manual occupation. This is because an injury is more likely to prevent you working in a manual occupation. For instance, when I tore my ACL and had surgery on it, I didn't need to claim on income protection because I have the capacity to sit all day. It didn't affect my ability to work. However, if I was a tradesman and on my feet all day, I would have been off work for months and would have needed to claim on the policy. All insurers price their occupation categories slightly different, so it's important to shop your cover around to find a good deal. You generally have the option to apply for a stepped or a level premium. A stepped premium will increase in cost as you get older. A level premium will cost more initially, but won't increase as a result of age. We typically don't recommend level premiums because insurance fills a short-term need. It is there to protect you while you're building your net asset position. As your net asset position grows, you should require less cover, which means that over time, you can consider increasing the waiting period, reducing the benefit period, or reducing the monthly sum insured. Given this, why would you pay more to lock in cover, which hopefully you won't need for the long term? Also, insurance companies are notorious for increasing level premiums as a result of product repricing. And the insurer that is best in the marketplace for you now might not be the best in a couple of years, and you may look to switch. Taking into consideration all of this, we typically don't suggest a level premium. However, every scenario is different and justification can be made in certain circumstances. There are two general categories of income protection: group insurance and retail insurance. We often recommend you opt for a retail policy. A group insurance policy is a form of pooled insurance arrangement which is offered by most super funds. Generally speaking, the benefits and options offered through a group insurance are restrictive. A retail product, on the other hand, allows you greater flexibility to tailor the cover to your situation and requirements. For many low-risk occupations, a retail policy is also often cheaper. Importantly, a retail policy will be medically underwritten at time of application. This process does take longer than cover that is not underwritten, but results in far greater certainty for you at claim time. To get a retail policy, I would suggest you speak with a financial advisor. As advisors, we have access to insurance product that you can't get directly. Also, your advisor can provide guidance on how much cover you need and ensure it is structured effectively. The underwriting process involves a series of questions about your medical history. This is normally done with either your advisor or with the insurer directly via a tele-interview. Generally, there are no mandatory medical tests as part of the application unless you have a large sum insured. However, further investigations may be required dependent on your medical history. This could include obtaining a medical report from your doctor or requesting specific tests and investigations to be done. If you have a pre-existing medical condition, the insurer may put a loading or exclusion on your policy. A loading is an increased premium, and an exclusion is an event where the policy won't pay. Let me give you an example of an exclusion. Both of my shoulders have torn labrums, and there is a very good chance that I'll need to have surgery on my shoulders at some point in the future. If I were to apply for an income protection policy now, I'd likely have my shoulders excluded because it's a pre-existing condition. This means if I did have surgery on my shoulders and was off work as a result, I wouldn't be able to claim on my income protection. However, let's say I was in a car accident and my shoulder got ripped out due to the force of impact. In this instance, the cause of the injury was not my existing condition. It was the force of the car accident. Given this, I would still be able to claim on the policy. If you do get an exclusion placed on your policy, ensure you read the wording of the exclusion carefully to ensure you fully understand when you are and when you aren't covered. It is a lot easier to go through the underwriting process when you're younger and have little to no pre-existing medical conditions. I did this myself in my early 20s and I have income protection with no loadings or exclusions, so my shoulders are covered. There is a term in the insurance world which we call clean skin. This basically means that you answer no to all of the underwriting questions. The policy goes in force immediately without any loadings or exclusions. If possible, it's good to get cover early on in your working career while you are still a clean skin. Not all income protection policies are the same. Due to the increasing costs of premiums, APRA made some industry-wide changes which impacted the features available under an income protection policy. The changes occurred on 1 April 2020 and 1 October 2021. Policies attained after 1 April 2020 can no longer have an agreed monthly benefit. All new policies are now indemnity only. Policies attained after 1 October 2021 have the following restrictions. The income replacement ratio is restricted to 70% of your income, excluding superannuation. This was previously up to 75% of your income, including superannuation. Ancillary benefits in the first 6 months of claim are restricted to an additional 20% of income, i.e. a 90% overall limit. Previously, comprehensive cover could offer up to double benefits during this period. Indemnity definition of pre-disability income is calculated over the 12 months leading up to claim. Previously, definitions could use the highest 12 months in the last 2 or 3 years to reduce the impact of fluctuating income. And after 2 or 5 years on claim, dependent on the policy, the return to work assessment analysis changes from own occupation to any occupation. Previously, it was an own occupation definition for the entire benefit period. Given the changes, the older income protection policies are actually better, but they are also a lot more expensive and insurers continue to increase the price. If you do have existing cover and are thinking about moving, just be aware of what you will lose. Your ability to earn an income is fundamental in the wealth creation process, and by extension, income protection is too. Given this, we include income protection as part of our financial housekeeping in stage 1 of wealth creation, when you're building your financial foundation. Don't be that person whose house burns down and they don't have home insurance. If you think income protection is an appropriate strategy for you, we strongly recommend you speak with a financial advisor. They can help assess the appropriateness for your particular situation. Please note, the information contained here is general in nature only and does not take into consideration your objectives, financial situation, or needs. As legislation is constantly changing, the accuracy of this information is only current as at the time of recording. Before relying on the information, you should check to see if the content is still relevant.